educational webinars. In this week's special session, we're going to explore my 3 favorite bar chart screeners. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist. And trading doesn't have to be complicated. You just need to listen to what the market is telling you. And my favorite screeners do precisely that. Be it identifying shifts in momentum and positive price action, the bend at the end of our friend the trend, or a picture of a crash, which is one of the best buying opportunities. But like all trading, nothing is guaranteed, and why there's an importance to understand probability and its associated risk. So stick around as I show you what I'm listening for and what that looks like while we examine real-time markets as I show you the setups and the opportunities they present. Now, before we get to that, this is where I usually introduce our moderator and Barchart's project director, Gene Baker. But Gene is away on assignment. So I've asked my co-host from Barchart's Market and Close, Twitter Tom, to step in. Hello, Thomas.
Hello, John. How are you?
Thank you very much for helping me out today. I appreciate it.
Well, listen, I can't promise I'm going to live up to Gene's amazing and stellar reputation, but I'm going to give it my best, John. I'm going to give it my best.
I know you will. You're a comparable co-host on our show on Friday, so I have no doubt that you will be good for me today as well. So just give Thomas a little slack today if you're asking questions, especially if you're asking about something specific about the website. You know that always you can send your questions to support@barchart.com. Okay, you ready to get started, buddy?
I'm excited for this one, John, so let's jump in.
All right, let me do this. So I want everybody to get, so let me do this for a second. All right, just to remind you that today's session is for educational purposes only, and that decisions to buy, sell, or trade securities or commodities or any other investments is best made on the advice of a qualified financial professional. Now, I would add that these are my enhancements and techniques, and they might not fit your risk profile or tolerance, and past performance is no guarantee to future results. So under no circumstances shall we be liable for any losses or damage that you or anyone incurs as of a result of any trading or investment activity that you or anyone engages based on this information or material you receive through barchart.com and our services. Okay, so the first thing I want to do is kind of set up today's session, and that is that we're going to look at 3 different screeners that are bar chart screeners, and they are found on our site. I'm going to show you where to find them. And the third is a variable or a precursor to another bar chart screener. So when we get to that one, just be patient with me. The second is that I want to spend more time on the setups and the risk management. Plus, I want to show you some of my personal enhancements that have narrowed down candidates and the rules of engagement, and we're going to spend less time on in-depth details of each of these screeners. Now, that can be found in focus webinars in our archives. And so if you go to our webinar recordings here, and this is for today's session, the 3 that we're going to be looking at is this eMACD, the end of the road, and something we're going to call is the 3-candle drop. So these webinars are here, and those will go into a lot more detail. All right, so let's start with the eMACD buy signal. Now, this is found under the investment technical ideas. And basically what this definition here says that it identifies shifts in momentum that could be downtrending or bottoming action candidates, could be a re-acceleration of an uptrend, or that impulse before or during a breakout. Now, not every one of these candidates are a good buying opportunity. We're going to need to construct some additional technical conditions to improve favorable probability. And before we jump into that, we need to talk about some tools and concepts. And so the first one I want to do is I'm going to come here where it says Barchart, flip charts, and I'm going to open that up. Now I'm going to show you a template that you can use. You can find that under your templates up here, if you're following up along on an interactive chart as well. So I'm going to open that up, and underneath here, we're going to see bar chart templates, and the template that we're going to use for this segment is the eMACD plus volume. So let me turn that on. Okay, so the E in eMAC really stands for exponential, and it's just a fancy way of saying a greater weighted to current price action over the previous look back periods. In this case, our 26-day and 12-day. Now, the difference between these two moving averages creates something called the MACD line, which is represented here by this black line. Now, a moving average of the difference between the 26 and 12-day over a 9-day period is called the signal line, and that is represented by the pink line. And if you go to the defaults, you can see that the black is the MACD line, the difference between the 26 and 12, and the signal line is the moving average of those, the 9-day moving average of that differential. Okay, so a buy signal is generated when the MACD line crosses above the signal line, and we can see that right here. Now, this is a positive divergence between the MACD line and the signal line. Now, the MACD is a lagging indicator, so you might see multiple days of positive price action before you actually get a crossover, and you can kind of see that here as well. Now, we also get something called a histogram here, and a histogram is that visual representation of this difference between our MACD line and our signal line. Now, what we're going to look at is something called the zero line, which tells us has two purposes. First of all, if the histogram is below the zero line, that is telling us we have negative momentum. Not necessarily that the market is going down or in a downtrend, just a negative momentum. And if it's above the zero line, represented here by these light blue or aqua, then that would be positive momentum. But we're going to use the zero line also for a reflection of trend tendencies. So if our MACD lines are below the zero line, this is called negative territory. And what this is telling us is that in negative territory, the market is giving it the tendency of a downtrend. And you can see that here. So here we can see our MACD lines are below our zero line. And what is our price action doing? It is in the downtrend. When we get above the zero, when our MACD lines are above the zero, as we see here and here, that means that the price action that you're seeing as the tendency of an uptrend. And this is really going to be important for us in terms of picking out what candidates we want to choose. Now, we're going to look at some additional confirmational information. And one of the things that we could do, just staying on this particular chart and template, is we can look at something called multiple time frame analysis. And so what we want to do here is, now before I move away from here, I noticed that these red lines here represent our most recent MACD crossovers at the daily level. So what we're going to do is we're going to go to a weekly, and what I want to do now is I want to see what our MACD is doing. So we're going to use the higher time frame, the weekly, to give us a trend bias. Now, we do see a positive crossover, which could be a positive sign, but not until we get about here do we see that our MACD line at the weekly level is in positive territory. In other words, at the weekly level, this is where this particular equity has the tendency of an uptrend, meaning that this is the bias that we want. So we're going to use this to give us permission to take trades. Now, a lot of the daily setups will come after that, but we just need permission from the weekly to give us that bias. And so you can see this would be the first daily MACD crossover that would be favorable to us. Now, the other thing we can do is we can go to a lower time frame and look for a corresponding MACD. Again, you can see that here we can see at the lower time frame, we do see our MACD lines in the positive territory. And a lot of times what you'll notice too is that you will get a crossover very close or just before you get that daily crossover. All right. Something else that we can look for from our MACD is negative momentum. So what I like to do is I want to find markets that have negative momentum, in other words, these brown histograms, but I want to find them where the MACD lines haven't fallen below the zero lines. This is kind of that correction, impulse correction, or retracement that we see all trends do. So finding a negative momentum without falling below the zero line. Now we can also look at moving averages. Now moving averages and moving averages crossovers. So what we want to see here is that our moving averages and our moving average crossovers are supportive and upsloping. So again, here we can see we got a MACD signal right around just after that we got the 20 crosses over the 50. Now that could be a confirmation. Again, here we have a signal where, you know, we have an upsloping 50, but yeah, the 20 is below. So we might wait until we get that confirmation from a moving average. Now here we got a signal, and this is definitely very supportive. We have an upsloping 20, upsloping 50, and you can see that price is well above there. Okay, and then another thing we can look at is the relative strength. And what is nice about the relative strength is we're going to look for bullishness in the relative strength without being overbought. So we want to find relative strength somewhere in the 40 to 70 area. And again, we might think about this in terms of, I want to see an upsloping, right? Upsloping relative strength that is not in an overbought condition. Now, what we'll see is in bull markets that you get a bit of a shift in the RSI, and you rarely will see in an uptrend where the RSI will go below 40, but really all we want to do is see the RSI above 50. And that is another way of telling us that we are having a positive momentum tendency of an uptrend, so above 50. Okay. So what I'm going to do here is now I'm going to take this screener, right, this bar chart screener, and I'm going to make some enhancements to it. I'm going to go to screen here, and what it's doing here is it's using the new MACD buy screener. Now what I've done is I've already set up my screener, and this screener that I'm going to show you is inside of the slides that we are going to look at today. So here it is. There's the new MACD screener. Now the first one here that I put in or filter is watch list. And what I'm doing here is, you know, you might be familiar with a set of stocks, or you have a watch list of stocks that you're interested in. And this is a great way to screen on those ones. But you also could think about something like, you might think of a macro momentum, right? You might be looking at certain sectors, right, that are performing well. Here's a great market sector performance chart, but you could, let's say, you could be looking at, you know, what sectors in the S&P that are performing, let's say, at the 5-day or the 20-day in the shorter term realm. And you can see which ones have a number of candidates that are above their moving averages. So you can use that as a micro as well in terms of a watch list or a fishing pool to draw from. But here's the meat and potatoes of this screener. What we're attempting to do, or what I'm attempting to do here, is I want to find those stocks on a percentage from the monthly low and the 6-month low that are exhibiting higher lows. And this is kind of that idea of an uptrend, right? An uptrend is a set of higher highs and higher lows. These higher lows are the first legs of an uptrend. So let's go to that. And notice that big list that we just had is now narrowed down to just a handful of candidates. Now, what I want to do here is I'm going to look at our 1%, our 1 month percent and our 6-month percent. And if the values are the same, that is telling us, or relatively the same, that we're telling us that we are at or near or using the same low. What we want to do is, for instance, here in potash, we're 11% above the 6-month low, but we're about 4.5% above the 1 low. So in essence, if we think about this, we are making a higher low. And let's see if we have another candidate down here. We have Visa as well, right? Now, what was another thing I said to you? Well, we could look for candidates based on an idea or condition of RSI, but let's just look at these two quickly. And so that was potash and Visa. And so let's go back to our template. And here's potash. And what do we see? Well, we see our MACD is below our 0 line, so we're not in the tendency of an uptrend. Now, it doesn't mean that this can't be a good candidate, and maybe this is the beginning of a new uptrend. But what I probably want to do is I'm going to either wait until my MACD signal lines are, MACD line and signal line are in the positive territory, and that might mean where we might need to get price up here, or what I'll wait for is a secondary eMACD signal, which has yet to come. The other one was Visa. And again, very close to getting to above the 0. And again, that might be that I need to get above here. Now, what we could also do is inside of our screener here, my screener, is we talked about RSI. So again, if I go down into here, RSI, and I select the 14-day relative strength. And again, if I say, let's just look at those candidates that are above the 50, right now, I really have narrowed this down to 2 potential candidates. So, not every day you're going to get great candidates. Again, we want to make sure that we set these conditions to it. Some of the other things you can think about in terms of conditions is, you always want to check volume. That's a good way to help you with your process. So let's go look at the Visa for a second. And what do I want to do? Okay, here we go. So, again, when I'm looking at volume with the MACDs, if I have a crossover that's in the negative, I really want to see a spike in volume just prior to that crossover. That's a good positive sign for me. The other thing, when I look for our positive crossovers, again, let's say here, you can see that here, I want to see volume at the crossover that carries through the crossover. So negative territory, I want to see the volume prior. Positive territory crossovers, I want to see volume at or after a follow through. And again, a lot of times when you come into one of these trade situations, One of our other templates that we have in Barchart, what we call our day of templates, is I can look at floor traders, pivots, and internal momentum for that day. That could help you with timing your entries on the day of action. Okay. All right. The next screener is a little bit hidden, but it's in basically the same jumping off point. And it's under our investment page. And it's called the end of the road. Now, the end of the road is basically that bend to the end of our trends. Now, what I like about this screener is that it doesn't give you a lot of candidates. I'm looking today, we have no candidates, which tells me that it's doing a good job. In other words, that it's very discerning and it's very selective in its discovery. Now, for most days, you'll get one or two end of the roads, but occasionally you might get multiple candidates. And this could be a larger sentiment picture. In other words, if you see a lot of candidates are found in the same relative sector or industry group, that could be telling you you're seeing a bend at the end of a much larger segment of the stock market. But the bend at the end of our trend is what basically this screener does. It's identifying market sentiment shifting from bullish to bearish. And what I love about it is because it is simple and pure, and it visually is very recognizable, and with little confirmational technical evidence, it's going to offer you some high probability, low risk, high reward opportunities. Now, we need to talk about a little bit about gap theory and how gap theory plays a role in trend analysis and recognitions of trends. So first of all, gaps represent an imbalance between buyers and sellers. It's the greatest imbalance between buyers and sellers. And you think about price is the record of a transaction. So a gap is evidence of an absence of either buyers, gap downs, or sellers, gaps ups. Now, there are different types of gaps based on the phase of a trend. We have breakaway gaps. We have runaway or continuation gaps. We have exhaustion gaps, and we have reversal gaps. Now, a reversal gap is an end of a trend, and every ending is also a beginning. Another piece of evidence from gap theory is that gaps act like magnets when price returns to the gap. And it tries to fill that void, only to remember the reason why that gap was created. Now, returning back into the direction that the original gap was created. And you can see that here. This is a great example. Here we have a gap up, price falls back, remembers why it gapped up, and then continues in that direction. Here we see price gaps down, and then price comes back, fills that gap, and then returns into that original direction. So end of the road gaps, typically that first impulse drives price directionally. And that directionally has some behavioral characteristics. The first one is that you break a intermediate trend line. And you can imagine here, you can see that here we have a nice trend, and here we see price breaks that trend line. The other thing behaviorally is we want to see price break one of our more standard or common moving averages, the 20, the 50, or 200-day. And so here I've added the 20-day moving average, and you can see in this case, we can see that price broke the 20-day moving average. Notice that we have a reversal gap here, but that reversal gap didn't break the 20-day moving average, right? The other thing is we want to see gaps of larger than 2%. And a catalyst. What's the catalyst, right? I don't really care what it really is. I just want to know if there is one. So for instance, we could have macro catalysts, like for instance, Fed speak, but a lot of times for stocks, it could be, an earnings miss. All right, so let's go back to the moving average concept here, because this is going to be important in terms of risk management and setting up our targets for our end of the road gaps. So what I've done here is I've added our bar chart template that has the 20, 50, 100, and 200-day moving average. Now we're not going to use the 100, so I'm just going to turn it off to declutter a little bit. So moving averages can act as support, or when you violate a moving average, it can accelerate price. Moving averages can also act as targets, and it can act as resistance in terms of what we're going to try to set up, which will help us with our entry and risk management. So again, let's look at this end of the road gap, right? We fell below the 20-day moving average, and that directional thrust fell to the 50. The 50 acted as support, and then price returned to fill that gap. All right. So let's go back to our screener. All right. Let's see. Excuse me. All right. So I want to go to our end of the road screener. Okay. Here we go. So first of all, we're going to do is we're going to have a screener in the end of the road gap. It's going to identify if these companies have options. And because really shorting is difficult, but it's a lot easier using options, and also options, you get greater leverage. Now, some of these are just data points for comparative analysis, but here's kind of the meat and potatoes of this screener. First of all, we want to see a medium-term bullishness. In other words, probably going to see price above the 50-day moving average, and or you might see the 50-day moving average up sloping. We want to break a significant price level, in this case, a new 5-day low. Think about that. 5 days of trading is most likely, if you're breaking that low, you're breaking a new weekly low. We want to fall through the 20-day moving average, and this is a new sell signal where price falls below the 20-day. And then our gap down has to be 2% or greater. Now, on this one here, you might get a little confused here because it does say less than value, but notice how it says here gap down values are negative. And this goes back to our days in elementary school. Remember, if you have a negative number and you want something that's more negative, right? You subtract from it, right? Or less than from it. So we want to see those negative gaps of 2% or greater, which would be, in this case, a less than value. I know that's kind of complicated, but I think if you think about it, you understand it. And then the average shoe range, again, this is more of a comparative tool for us. It's just another measuring stick of price movement, something that I like to use. So if I'm on the fence on terms of a percentage-wise, if I see a gap of greater than one average true range, that is usually a good confirmational tool as well. Again, industry groups here, or you could sort by a very particular watch list. So our default is the S&P and the NASDAQ, all right? So there's two setups here that we're going to do. And the first one is called gap and go. So let me kind of make a smaller chart here. So on the day of the gap, the day of the end of the road gap, this is really for day traders and options traders. What we're going to do is we're going to do something called a opening range breakout, and we'll sell when price breaks out of the opening range candle. Now, depending on the style of the trader that you are, in terms of day trader, you know, that opening range candle could be a 5-minute, a 15, 30-minute, 60-minute, depending. Now, personally, I use the 30-minute. So you can see on this one, this would not have been a good day trader setup because it never really did break out of the range. But once you break out of the range, you set your stop at the high of above the high of the opening range candle, and then as price moves down, you adjust your stop on each new intraday low off of each intraday high. So that's kind of the day trader setup. For an options trader, right, you can think about momentum, and you could say, all right, well, here is an entry level. I could use these values as a potential strike, and then I could either use the gap as my risk, or I could wait for a confirmation, in other words, another day lower, and then use this as my level of risk in terms of where I'm going to choose my strikes. But that's not the setup I like, all right? The setup that I like is the second setup, and this is the one that's going to give you those high probability, high reward, and low risk trades. And these trade occurs after the impulse, after that directional move where we create a short-term bottom. And that's exactly what we see here. And what we're going to do is we're going to wait for price to return and retest the gap. Now we're going to look for some concentric data points for our entering. Now some of those could be a moving average. Again, think about what I just showed you. Moving average that could have been supportive now could become a resistance. In this case, what we see is another data point, which is a broken support level. Old support becomes new resistance. Fibonacci's work, Bollinger Bands, especially in lower time frames. Bollinger Bands can help us find good entry opportunities. And so let's look at that. So what I'm going to do here is I'm going to come back in here, and I'm just going to add Bollinger Bands at this 30-minute time frame. And you can see that, wow, right? A big Bollinger Band thrust outside of our Bollinger Bands that came into our broken support that filled our gap. And so that would have been a great entry opportunity. Now, what we'll do is we'll set our risk at the candle that closed before our end of the road gap. In that case, that would be on the daily level. Let's look at that on the daily, and I'm going to turn off my Bollinger Bands. That would be this candle right there. All right. Right, we did Bollinger Bands, and okay, another thing that we can do on days of entry, in other words, when price is coming back to fill those gaps. Again, one of our templates that I would recommend you to use, which I basically call my day of entry template, is our 13 EMA pivots. Now, these are the pivots for today, but what you could set up is, you know, if I'm looking for a shorting opportunity or an entry into the market, if I can find one of my pivot values that is near my gap or near other technical information, that was more evidence that that's the area where I want to be patient and wait for price to get to before I set my entry. Okay. All right. So let me show you a couple other quick examples, and then we'll move on to some other. So here's train. And here we go. So here, you know, here is that end of the road gap where we broke through the 20 and we found support on the 50. So notice what happens here, right? We fell below the 50, we recaptured the 50, but we did not get above the 20-day. So this, for an options trader, this would be a really good trade, because what we could do now is we could use the strike value of the 50-day moving average when price falls back below it as an entry level. And they'll say we could do, let's say, a credit spread. In other words, selling calls. So we could sell the call that is represented by the 50-day moving average here, and we could buy the call that is represented by the 20-day moving average. So that'd be a credit spread. Now, a debit spread, we could buy the put that is represented by the 50-day moving average, and we could set our target based on the 200-day moving average, and that would be a nice debit spread. All right. Amazon. Well, Amazon, what? Amazon, end of the road? Yeah, watch this. Okay, look, there we go, end of the road, right? Big gap, broke an intermediate trend line, and I'm sure that there was a news story that was related to it. We fell through the 20 and the 50. Directionally, we ran towards the 200-day. Now, why did it stop? Why didn't it get down to the 200-day? Gap theory, right? The power of gaps that can act as support and resistance. Notice how the market held that gap. Now it ran back up and came back and filled our gap. And that's what we would have been looking for, that entry. Now, again, look at this one in terms of risk. So the entry would have been here, right? On that gap fill, we would have risked this candle that the gap was created before the gap. And that would have been only about, 2.5 points. And then we could set our target at the 50-day moving average. So this would be a 2.5 point risk for, it looks about a 12 to 13 point reward. I don't know about you, but sign me up for, 4.5 to 5 to 1 risk reward trades every day. Here is Philip Morris. Again, a little bit of a different setup here, but you can see our end of the road gap as both our 50-day and our 20-day are crossing over. Again, another bearish sign. And, price falls down right now. I don't know why it did not get as far down as the 200-day. Probably there was some kind of support over here. But notice how price returns to fill that gap. So let's think about some of those concentric data points, right? Broken support, right? Again, here we can see where we've came to that broken support. Let's go down to a lower time frame. Bollinger Bands, right? We said Bollinger Bands could be a good indicator on lower time frames, right? Nice Bollinger Band confirmation. And let's go back to our daily. And I'm going to turn off Bollinger Bands. And notice that also here is where we encounter our downsloping 50-day moving average, which is now acting as a level of resistance. And so this would be a nice trade in terms of an options trade. Again, entering a strike based on the 50-day moving average and setting our risk based on complete gap fill. All right. So that is the end of the road. I see a couple of questions here. I'm keeping up with them. Looks like it, right, Thomas? Right. A question here about, is the end of the road only for long-term trends? Yeah, I think it's not really long-term, but at least intermediate, right? And so it's somewhere between 2 to 6 months is you probably need that information to do that analysis. Okay. All right. All right. So the third one is a little bit of development. All right. So we're going to look at a very particular screener that I'm going to show you that I've created, but we're going to relate it back to a bar chart screener. So what we're going to see is the precursor for what is called the 3-day bounce screener. All right, so I need to go to my slides on this one. All right, So here's the 3-candle drop screener. Now, basically all this is a screener that is going to help me find candidates that the stock price falls 3 days in a row. That's all it really is doing. Again, I can look at a certain set of watch lists or sectors or whatever. If I don't want to do that, I could just let the screener pick the NASDAQ, the NYSE, and the S&P. All right. What I'm going to do is I'm looking for a very particular picture. And that picture is a picture of crash, where selling overwhelms momentum and price falls enough that buyers step away. Now, what we do, eventually what happens is that buyers are attracted to a falling price, sellers become satisfied. In other words, they are filled. And what we want to see is this picture of a cascading waterfall. Notice this symmetry that we see here, okay? So what we're going to do here is, this is not a selling opportunity. Trust me on this one. We're going to add some conditionals and some confirmational evidence, and this is a buying opportunity. So what are some of the conditions that we're going to look for? Well, we're going to wait for this green candle to close. And then once that green candle closes, our risk is going to be below that green candle, or in some instances, it could be the red candle, whichever is the lowest of the 2 points. And what we're going to do is we're going to wait for price to close above that first green candle. So think about this. If I see a picture of crash, and this is our daily candles, right? So we have 3 days down. Now we need a 1-day green candle, and then we need a 2nd day confirmation. So this happens over 5 days. So there's no rush to get into this one. But here is an example of it, right? So a 3-day crash, that cascading sell-off, right? We want to see this kind of this symmetry, smaller, medium, larger. And then we wait for that green candle to close. Now, the targets here on a shorter term basis will be 1, 2, and 3. This is where 1 is where the last and the second candle break. 2 is where the first and second candle breaks. And 3 is the origin of the sell-off. Now, what is typically important in this one is 2 thoughts. If we cannot get back above the first and second targets, and then we break the green candle, that is a continuation of a downtrend. Now, that's a little bit more rare, but it is an opportunity if you see that. But what we're going to look for is these higher probability trades where if you can get above the origin of the sell-off, target number 3, what we can do is we can do a 100% extension. In other words, from peak to trough, then from where we break out above, we add that value, and that will give us an extension target. And that is really important. Okay, so let me do this. Let me show you some historical pictures of crashes so you can kind of visualize this. And then what I'm going to do is we're going to kind of move a little bit away from this. So here's the flash crash of May 6, 2010. Some of you might be familiar with this one. This is actually a 1-minute chart, by the way, but you can see that, okay, so this is a 4-candle crash, but you can see that symmetry, right? An acceleration of price, a cascading fall. And again, the last candle, it's not the body that we're really concerned about in terms of that largest candle, it's the range. Notice how the range of this candle is the largest of all of the candles. There's our green candle to close. There's our green candle to confirm, and then there we can see how price returns. This is the flash crash or the crash of election night 2016 in the S&P. Now, this one has a little bit of a nuance to it, right? But you can see that cascading sell-off. There's our green candle. And again, I'm really just kind of showing you what certain pictures of what this looks at. So look at flash crashes and these kind of pictures of crashes, our three candle drops, are rare occurrences at the daily and weekly level. If we can find them, they are really great trades, but they're very numerous in intraday, 2 to 4 hours, 15, 30 minutes. That's where you're going to find a lot of them. Now, ideally, we like to see crashes into levels of support. So let me show you this one. Here is aluminum. And I know a lot of you wouldn't trade aluminum, but I just want to show you how rare this is. This is a weekly chart, right? And there you can really see that picture, right? That picture of, this cascading sell-off. Wait for the green candle. Notice that the green candle here, its wick is a lot farther below, so your risk would be this low point. So there is a fractal nature of markets. In other words, we might not see a perfect crash in a daily chart, but if we break down the daily candles, we might find some micro crashes in those intraday charts. So let's go to first one. Let's do SJM. And let's change this back to daily. All right. Okay, so not a classic, right? But certainly think about this. Is this a cascading sell-off, right? A vicious price movement, right, in this particular equity? Yeah, it is. So what we're going to do is we're going to look at this candle, right? We've recognized this cascading or this accelerated sell-off. We're going to go inside this candle at a lower time frame. So the low time frame on this one is 30 minutes. There's our circle, and lo and behold, there you go. 1, 2, 3. Here at the bottom of that red candle is your capitulation crash and your buy opportunity. Now, yesterday I was setting this up was Whitestone REIT, and again, condition, confirmational, right? Here's our 3 candle crash. There's our green candle, yes, but no confirmation, right? This could be by the end of the day, we don't know, but right now it doesn't look like that, right? We don't know if we're going to get back above here conditionally, right? Confirmationally, excuse me. So again, patience. Make sure that you find those setups. All right, here's Tesla. All right. And let me change this to a daily. And there's a couple setups here. Again, look, that kind of that cascading. So that's what we see here, right? We see our green candle. There's our green candle that allows us that trade. Now let's think about this green candle. When this green candle opened up, it opened up down here. So it was actually a red candle and actually traveled lower before it closed above our green candle. Again, condition, confirmation. Be patient. Here we see a lot of messed up stuff, right? I mean, this is kind of crazy, but we do see this cascading sell-off and another one red candle where we see a rapid price decline. So let's break down this cluster of candles. And let's go to a 2-hour chart to do that. And there you can see it. There it is. And as sure as it snows in the winter, 1, 2, 3, there's that crash, the end, the satisfaction of sellers. Buyers step back in. Not only a crash here, but we have a nice double bottom here. There's our green candle, there's our confirmation, and then off we go. Now, what's interesting on this one is, and this is a little outside what we're talking about, is I find it interesting that the market comes all the way back and tests our confirmational area. And this could be a liquidity trap, I think that this was, right? You know, stopping out folks that maybe were down in here. But notice how it held support and rallied away. NVIDIA, okay. All right. There you go. 1, 2, 3, right? Not necessarily in a downtrend, right? Just as a correction in a market that is continuing to go up, right? NVIDIA is a stock that just doesn't seem like it wants to go down. But what do we say about crashes, right? Or if we can get back above the origin of crash, target number 3, then what we can measure is the peak to trough, add that to our breakout to give us a target. Peak to trough here, about 9 points. Breakout to target, 9 points. Very, very reliable in terms of targeting. Okay, so now we know what a picture of a crash looks like. And so let's go back to our investment page under our Barchart screeners. And we're going to go down here where it's called the 3-day bounce. Now think about this. What are we looking at? We're looking at those stocks that have exhibiting bullish tendencies after a short-term downtrend. In other words, can I find a picture of crash among one of these candidates? And I'm in that home run game, right? I don't care about that target 1. I don't care about that target 2. I want to see this company or this stock where price is now taking out target 1 and 2 and looks like it's going to take out target number 3, and then I can do that extrapolation and get a much higher target. Now, a lot of these here are, you know, penny stocks, so or may not have a lot of volume. But let's just see what happens. I don't know. You know, it changes. Okay, there you go. 1, 2, 3. There's our crash, right? There's our crawl back. Well, we haven't got above target 1, right? So not there yet. Haven't got above target 2. Not there yet. But again, something that we could look at. What was the other one that was a much higher volume here? Oh, First Builders. Let's see what that one looks like. Okay, so again, you know, you gotta kind of use your imagination here, but you got to see that kind of that sell-off, right? Again, it's not about the bodies, it's about the range. Again, could this be a potential trade where we're getting above the origin? We could figure out the peak to trough, and then we could figure out a potential on that. So let me show you a couple examples. That was what the screener is coming up with today, but let me show you a couple examples of recent. Oh, nope, wrong symbol. Excuse me, I have typed in the wrong symbol again. Okay, so this is Baker International. All right, there's our crash, right? There's our crash. And now we are above the origin of the crash. So we could measure this length of this trade and then add it. Now, there's not a lot of reward to risk in this one. It certainly looks like it's like a 1-to-1. And what are you going to get out of this? About $1. But again, I just want to show you that methodology. Here's a Freeport McMoran, which is kind of interesting, because this is kind of a sore one. This is one of the stocks that was in my portfolio. But again, look at that vicious downtrend, right? Excuse me, price action, you know, and again, you know, are we getting, you know, that kind of that bounce? Now, again, let's break down this daily candle. I'm going to go to a lower time frame, and there you go. 1, 2, 3. There's our green candle. There's our confirmation right there. And then where we've gotten past target 1. Certainly, we're coming close to target 2. But what's is kind of interesting in this one is, you think about bringing this full cycle, is this crash retracement is also what looks like that potential gap fill of an end of the road gap, which means that there's going to be a battle soon, and that battle might come somewhere inside of this gap. All right, let me show you one more, and before we end today's session. All right, so this was one that I just saw. There's our crash, 1, 2, 3, right? There's our, looks like, again, we've gotten past target 1, we're on target 2. Again, not getting there yet based on target 3, but let's do the math on this one, right? Well, you know, we've fallen, you know, about $5 here, and if we break above here, let's say the 73.50 area, 73.70 area, we had $5. That puts us near, I don't know if this is all-time highs, but it's certainly most recent highs. And I'm sure at the time of breakout, that $5 movement, I'm probably going to get into this one, you know, again, based on where the breakout is. You know, maybe I might be risking $2 or 2 points to make 5 points, which is a nice 2.5 to 1 ratio. And again, in options here, you could probably use some kind of options strategies. Okay. So I'm just following up on a couple of these, Thomas. So I'm looking at some of these. It looks like we've answered most of them. And some nice comments too. I appreciate that. Okay. All right, so what are my final thoughts here for us to end for today? All right. Each of these screeners here, let me do this. Whoops. There I am. Each of these screeners here are different stages of market movement, right? The MACD is this ideal of a change in momentum. Could be the bottoming, but what we're going to do is we want to increase probability. We want to increase success. So we want to see where the MACD is above the 0 line and where we see positive price action, RSI. End of the road, what is that? That's the end of a uptrend, right? That sudden change, right? Now, usually that has some kind of fundamental variable. Typically it's an earnings miss, but it's also this development of a downtrend. And so many markets that are in longer term bull trends, there's kind of this battle that goes on. And that's why we want to be patient and wait for that price retracement that tests that end of the road gap. Remember, think about clusters of evidence, broken support, moving averages, Bollinger Bands, Fibonacci's. I forgot to show you in a great example. Take the movement of the tie at the gap down and the preceding new low and do a Fibonacci extension on that. And what you'll find is a lot of times on that gap fill, that 61.8% is where market will return to. In uptrends, you usually get retracements around the 30, you know, that 31, 32 area. In downtrends or bear markets, you usually get that 61.8. Okay, so That's just a difference between bulls and bears. Now, 3 candle drops, again, not a selling opportunity, is this capitulation, this cascading sell-off, right? It's often found at the end of a down move or a very swift correction. We saw 2 of them, Amazon and Tesla. Swift corrections, the market, right? Fear comes into the market. Wait for those confirmational and conditional, right? Green candle, close above, right? You know what it looks like now, and the screener we're going to use is not the 3 candle drop, but the 3-day bounce. We want to find those ones that are going to give us that much greater reward on that extension, okay? So each one of these are dynamically different, right? The key to success relies on discipline and rule-based risk management, okay? So always know that where your risk is and what is your plan if the market does not do what we think it's going to do, right? So be aware of that. All right, folks, I know I went a little bit over. I appreciate it. I hope you guys enjoyed the session. I see a lot of nice comments. Next week, we're going to, where are we? Here we go. Okay, next week, we're going to do, oh, by the way, if you're looking for the slides that we showed today, if you go into archive webinars, there you can see winning screeners, and there is the slides for today. So next week, upcoming webinars, we're going to look at Heikin-Ashi candlesticks. A little bit different than your traditional Japanese candlesticks, but we're going to talk about how it's formulated, how you can use it. It's a lot easier to identify trends in Heikin-Ashi and some of the risk management that is around that. So come and join us for that. Until next time, folks, best of health, manage your risk, and the good of all trading.